Soya Investing Channel, aka Sit on Your Arse Investing. My name is Colin, your average investor searching for above average returns. Today's topic is about looking back at Warren Buffett's purchase of Store Capital. What is Store Capital? What does it do? Why he bought it? And what's the future of Store Capital? Let's dive in and let's get started. Now, back in 2017 and 2020, Warren Buffett bought Store Capital. He bought it based on funds from operations multiple of around 13. If you look at his average price, he bought it around $20.25. If you look at the history based on the chart, he bought it around this price, and then it kind of soared upwards, and then due to the pandemic it dropped again, and then again he bought it one more time, so two times, right? As of right now, he's got about close to 9%, 24 million shares at $800 million. So what is Store Capital? Basically, it's an acronym called Single Tenant Operational Real Estate. They are a REIT, and basically they help the business owner. They buy the land, they build the land so they can operate a store so that the business owner isn't burdened by the real estate, so they don't have a lot of debt. That way they can expand even quicker. So it's kind of like a win-win situation for both parties, right? They have, if you look domestically, they only domestically in America. They're in many states. They have about 2,800 properties, and diversified in many verticals: manufacturing, service-oriented retail, services. They have like movie theaters, medical, home furnishings. Their top 10 customers, you see here, they have the Bass Pro Shop. Not one is more than 3% of the revenue. Okay, I see this as like the Shopify of brick and mortar, small, mid-sized companies. They don't do the Walmarts or the Home Depots of the world because they know that the return on investment won't be as high, because they're going to ask for more favorable terms because they're grade A companies, right? So they focus on the small, medium-sized companies. Now you might say to yourself, "Oh, okay, there might be more risk involved by renting to these companies." Well, if you look at the financial chart, okay, Warren Buffett looked at it and looked at the sales, and you see back in 2012, it's growing really nicely, okay, to 2017 year. And also, they've never had a losing year, okay? And then if you continue on, you look at the pandemic, what happened? They still never lost any money. It's always been profitable, right? Even you look at the quarterly, most recent, always been profitable. So one of the reasons why they're profitable is because of the four table stakes. Okay, they do look at the profit loss of the company, make sure they're a good profit center, like they say, and then they also like to combine all their leases into one lease. So if the store has like multiple stores that they're doing, they combine it in one store. So in case one is not profitable, the business owner can't cherry pick and just say, "Oh, I think this is not good, so I want to get rid of it." And then they also invest at or below replacement cost. Obviously, when you invest in tier two companies, there's going to be companies that do go bankrupt. So they do have to sell it off. So they've got to make sure that they can, when they sell it, they can make money. Here's an example. This is the 2020 CEO letter. During 2020, they sold 48 occupied properties, and they still got a cash yield of 7.4%. And they were able to reinvest that into new real estate with initial lease yields of 8.1. So this is a very disciplined company. They know what they're doing. Okay, if you look at the CEO and just give it a listen. This is the original CEO, one of the co-founders, Christopher Volk. Just give it a listen.
For my friends. So the first platform was a company called Franchise Finance, which we had public from 1994 to 2001. The average 10-year treasury during that period of time was 650. The second company was a company we founded called Spirit Finance Corporation from 2003 to 2007 as a public company. The average treasury was 450, and so today we're running this company, and the average treasury is today 250. The first thing I would say is that we can run these accretively for investors in almost any interest rate environment. The second thing is that the thing that really offsets risk for investors is what's the growth, and what kind of embedded lease escalations do you have, and also what kind of external growth can a company provide for investors. And if a company can do both those things, they can really offset and take a lot of the risk off the table. There's a notion out there that net lease REITs somehow, because the lease duration is longer, that somehow they should be more sensitive than let's say hotel REITs, where the leases are overnight. Right. And but that's really not the case. Because yes, we have a long duration lease, but we have the lease escalators that are built into it, and we have the ability to generate external growth for our investors, which is what we've done for 30 years.
For 30 years, they've been at it. They have that type of experience. This is when the pandemic and there was the shutdowns and all that.
So, and that basically means that they don't have a lot of free cash flow to be able to buy stock back. So last year, our free cash flow was $140 million. Our equity cap at the time was $9 billion. Today, our equity cap has gone down to about $4 billion. So we've lost $5 billion and change. If you buy our stock today, by the way, you can buy it for a 25% discount. Not even the founders could do that. And I don't expect the replacement cost of these assets is going to change anytime soon, and we've been buying assets for 20% discount to replacement cost. So it's very hard for REITs to buy back stock. If I want to show confidence, I'm going to buy stock myself, and our team is going to buy back stock. Our directors will buy back stock, and we've done that, and I've done it at far higher prices.
At that time, it was a no-brainer because buying it below cost was definitely a smart thing to do in this case. Now, Christopher Volk did leave the company. When I searched it, it just says without cause. I'm not exactly sure why he left. If any of you guys know, please leave it in the comment below and share it. That way we can all understand why he left. But Store Capital is still in good hands with the lady here, Mary Fadua. She's the new CEO, but she's been the co-founder since the beginning. Okay. If you look at the dividends, every year it's been increasing over time. So that is a good thing, right? Right now, it is $1.54, so you're getting a 5% dividend based on this price of $29. Okay, now you might say to yourself, how can be sustainable if it's 99 cents? Well, nothing could be further from the truth. When it comes to REITs, amortization and depreciation is deducted from the income, the earnings. But funds from operations is actually more important than earnings. Okay, because usually if it's well maintained, real estate appreciates over time. So the depreciation and amortization lowers earnings, makes the dividends seem artificially high, but really it's not, right? So look at the funds from operations. 2020, if you look at here, see, 2020 was $1.80. Funds from operations in 2021 was $1.88. So they can cover their dividend. And if you look at Warren Buffett, he never sold it. Even with the run-up, he bought it twice at his price of $20. His dividend yield is about close to 8%, with a 50% appreciation for the past 4 years. Okay, so that's what makes Warren Buffett Warren Buffett. So if you like this video, please give it a thumbs up. I hope you learned something, and I'm glad you made it to the end, and I'll see you in the next video. Thank you for your time.